Okay, good morning, everyone. Welcome to this week's Macro Monday, week 20. My name is Andrew Bresler. I'm joined by Edmund Liu from the Global Sales Trading Team. KVP is in Europe this week, so we will be covering him for this week and the next few weeks ahead. As usual disclaimers apply, not trading or investment recommendations. There's a lot to cover, so we'll dive right into it. Last week's summary, starting off with Macron winning the French election by a much greater margin than was initially expected by the poll, so 66 versus 34% victory versus a 60-40 poll. Trump fires FBI Director Comey, leading to comparisons with Nixon and Watergate. Wilbur Ross confirms there will be 3% growth will be difficult to achieve this year. However, on the back of Trump's tax reform and trade plans, achievable in 2018. US and China released the initial results of their 100-day action plan that forms part of this sort of comprehensive dialogue. We'll touch on that later. Moon Jae-in wins the Korean presidency. He campaigned on a softer stance with North Korea, so it'll be interesting to see how that rhetoric dovetails with Donald Trump's more hardline rhetoric. North Korea in sympathy fired another test missile. BOE in the UK, it lowered its inflation forecast and growth outlook for near term. This was seen as potentially less hawkish than some of the built-up expectations, with the idea that there was potential another hawk in the camp. Australia budget, this is seen as increasing fiscal spend on the infrastructure side of things, but however it did include plans to return to a surplus, and so there's potentially no impact from rating agencies here. China April trade data was weaker than expected. I think what's more important on this data is looking into the guts of it, and you'll see that there was a significant uptick in China's total exports to both the US and Japan, and Europe remains reasonably robust. So is there a potential read-through in terms of uptick in the strength of these economies? PPI and CPI data out of China relatively muted, a slight decline in PPI. In terms of German data last week, very strong data really across the board, with higher than expected industrial production, higher than expected GDP and CPI, in line with expectations, but strong data. UK industrial production declined more than expected. It's a pretty weak round of UK data that we've seen of late, and we'll touch on that later on in the slides. US retail sales and CPI data came in much weaker than expected on Friday afternoon, seeing a weak close into the end of the week, with risk assets not holding onto their gains. Running through the various asset classes in terms of equities, European stocks failed to carry the positive monthly momentum that they've seen in the wake of Macron's victory. You can see that strong performance on a month-to-date basis, but relatively muted sort of follow-through from last week's Macron victory. In the Nikkei, you will see a very strong week-on-week performance driven by weakness in the yen. Shanghai Comp continues to underperform markets due to Chinese tightening, as well as fears on the focus on shadow lending in the wealth management industry. In terms of volatility, you'll note the thematic continues there, where declining asset market volatility continues, week-on-week declines across the board, including both in FX, fixed income, and equity markets. From a fixed income standpoint, having steadily climbed over the last since early May, US 10 years traded above 2.4% for the first time since March. However, on the back of the weak CPI and retail sales data, crashed lower to close the week at 2.3%. In terms of FX, generally a higher week for the dollar, with safe haven currencies being the worst performers, the Swiss and the yen. Kiwi dollar tumbled 1.5% in the midweek on the back of a much more dovish than expected RBNZ. And you'll notice that Korea outperformance in the 1 month there as a function of the election of the new president. In terms of commodities, one of the best weeks for oil in a long time, up over 3% as a function of bullish EIA inventory data, and also talks of an extension of OPEC cuts. You'll also see that iron ore continued to fall and underperform as a function of both Chinese tightening fears and the heavy stockpile and inventories. We'll move quickly through the COT report. You'll notice a marginal pickup in dollar long positioning, CAD shorts builds, as do New Zealand dollar short positions. Mexican longs now at a 52-week high, and you'll see a big switch in selling of yen. The position now net short yen versus longs prior week. Commodities, really, the trend of the previous week continues with a reduction in long exposure in both the energy sector, metals exposure, and also a reduction in grains shorts from the prior week. In terms of the week ahead, I think there's three key events this week. The China data dump being the first of them. That happens today at 10 o'clock our time. UK data coming out later in the week, and Australian jobs data. Central banks, we have Mexico at 6.5%, no change expected, and the BI in Indonesia at 4.75 with no change expected. Mester, Bullard and Williams speaking from the Fed side of things, and a host of other speakers including RBNZ's McDermott, Merkel, May, Schubel, ECB's Nowotny, Mersch and Draghi, as well as former Fed Presidents Bernanke all speaking. In terms of economic data, reasonably light, but with a few highlights. So the China data dump I talk about, which I'll get to in a minute, but retail sales, fixed asset investment and industrial production. On tomorrow we have UK CPI data, I think the highlights. On Wednesday, average hourly earnings and unemployment from the UK, as well as CPI from the Eurozone. On the 18th you have Aussie jobs data and UK retail sales, and on the 19th Friday, German PPI and Canadian retail sales. So in terms of the key events for this week, the Chinese data dump, this will garner more focus as there's been a recent amount of sort of a recent increase in the intensity at which the market focuses on Chinese economic data. This sort of playing into the global reflation trade. I think it's probably too soon to make that leap. I would argue that Q1 was more an anomaly versus trend higher than a weakness in sort of Q2 data that we're starting to see. And so I would also say that China is tightening from a position of strength, and I think that's an important caveat to make here. The Chinese economy is relatively robust at the moment, and remember that any fears on Chinese weakening will be met with loosening should it need to be, given that this is a very important election year. So leaping into a very weak China story is probably a move too far at the moment. In terms of UK data, we've got inflation, unemployment, and retail sales. As I mentioned, the data and expectations here. For me, though, I think we are potentially at a point where sterling is now overpriced, given how well the Brexit outcome is priced at the moment in terms of a best case scenario and a soft Brexit, given the recent call for snap elections. Economic data started to turn to the south as inflation picks up, resulting in real wage compression. This tends to be a negative to the growth outlook, and so I would argue that potentially sterling looks like a sell here, and I would probably choose a euro sterling higher, which I believe Edwin will touch on in the technicals. As far as Aussie jobs data goes, 5% unemployment and 5k employment change expected. We've had a string of recent weak Australian data, whether it's building approvals or retail sales. Couple that with China fears and commodity price declines. Aussie's been the worst performer among the G10 commodity producing currencies month to date. I would argue that maybe this is now getting towards the end of that particular trade, and maybe a decent print from China today or the decent jobs data expected in the middle of the week may see a basing in Aussie as a trade. And I guess with that, I'll hand over to Edmund for the technicals.
Okay, thank you, Andrew. So we'll first start off with dollar yen on a weekly chart. So what we have here is a descending triangle, which is technically bearish, but as you can see, after the breakout to the downside, it managed to reclaim the triangle after about three weekly consecutive closes. And so right now we have two closes above the triangle, as well as dollar yen trading above the Ichimoku cloud. So that's technically bullish. But if we look at the Fibonacci, it's actually testing this 23.6 retracement of the up move from 2016. It has previously rebounded off the 50% retracement. Now we're testing the 23.6 retracement as a resistance. So we really only go bullish on dollar yen if it manages to close above that 23.6 resistance, which is about 114. For gold, as you can see, it's supported on the 2016 trend line, as well as more recently the 2017 trend line. Last week, we tested that trend line, and the support managed to hold. Right now, we are about the 1220 support region. If you look at the next chart, which is on a daily basis, you can see that gold is actually has its stochastics oversold. The last time this happened in about March, we did see a rally, as you can see over here. So right now the stochastics does suggest that the momentum is shifting to the upside. However, interestingly, if you look at gold on a longer term basis, it's been capped by this downward sloping trend line since 2012. So if there's any kind of a rally, we believe it should find resistance there as well, as it has done so many times in the past. So resistance is about 1280 if we do see a rally from here. For euro, post the first round of the French election, we had this gap. It did not fill, so that's technically bullish. For euro, we're also sitting on the 200-day moving average, so it's supported by that. However, if you look at longer term, which is the weekly chart for euro, we are still trading under the SMA 100, which is the 100-week moving average, and that has capped the gains for euro all of 2016 and as well as last week. So that's technically bearish for the euro, especially when we look at it from a longer term basis. The other way we can look at it is through the DXY, the dollar index, which is just the inverse of the euro chart. In the DXY, we have a falling wedge, which is technically bullish. So as you can see, the slope of the lower support is gentler than the upper resistance, so suggesting some kind of support there. So the upward bias for the DXY does seem to suggest a lower euro dollar this week, at least technically. For euro yen, stochastics are overbought. As you can see, the upside momentum seems to be getting exhausted. On a weekly chart, you actually have a hangman candle, which basically tells you that the upside momentum is at risk, and it seems to be ending, as you can see over here. So we had 1, 2, and 3 weeks of advances, and then we have the decline, the hangman candle over there. So that suggests that we see a lower euro yen this week. For euro sterling, as Andrew mentioned, sterling is a bit of overpriced. So if you see a lower sterling this week, you should see euro sterling trading higher. Technically, it's broken above this trend line resistance. If you look at it on a longer term basis, which is the weekly chart, we actually have a descending triangle. So that's technically bearish, which is inconsistent with the daily chart that we saw earlier. So we'll probably be looking for confirmation in subsequent trading sessions. But of course, if it does break above this upper resistance level, that's where we would be bullish on euro sterling. We will get confirmation of this bullishness. So crude oil prices seem to be turning around, and if that actually happens, if crude oil trades lower, you should see dollar CAD trading higher. We have the symmetrical triangle breakout on dollar CAD. So you can see, so we had like 3 closes above the symmetrical triangle already. As well as if you look at this for Fibonacci, which is the retracement of the down move from 2016, it does seem to bounce off a lot of these Fibo levels. So if you were to buy dollar CAD, we'll probably be looking at the 1.38 as 138.40 as the next level of resistance, because as you can see, dollar CAD has been resisted at the 50% retracement. So the next level of retracement will be the 61.8% retracement, which is about 138.39 as you can see over here. And lastly, moving on to equities, we have the Nikkei. A lot of the equity indices are either finding resistance at all-time highs or at previous highs. So if you look at the Nikkei, we had the Nikkei turnaround just at the 20,000 level. This was actually the high in 2016 in Q1. The stochastics, which is not shown here, but it does reflect a bearish crossover, so indicating the upside momentum is actually starting to fade. And for the S&P 500, the weekly chart, again, it shows you it's at an all-time high, but it just can't close above 2,400. So bias is probably a little to the downside. If it does correct, then we'll be looking at the first level of support will be a 23.6% retracement at 2262, which is about a 5% decline from the current level. Interestingly, you can see also the ATR, which is a measure of price volatility, that has also declined since 2016. So in 2016, we had price moves that were some 86 points per week, but right now we are down to something like 33 points on a weekly basis. So right now S&P only moves about 30-ish points every week. And if just following on the ATR, this was something we did. If you look at all the currencies, the most volatile of them would be the silver, followed by palladium and platinum. So obviously all the metals are right up there. ATR is 1.95%, indicating that if you actually trade silver, it does move by 1.95% a day. So that obviously opens up opportunities for more gains and losses, of course. And if you look at equities, they're right there at the bottom, like the Dow, the S&P are basically not moving at all, as you saw with the declining ATR. So these guys move about 0.4% on a daily basis, whereas the most volatile equity index right now would be Italy, Portugal, Denmark, the European indices, where they move approximately 1% a day. Okay, that's it from us today. If there's any questions or feedback, please mail us at macro@saxobank.com, and have a safe trading week ahead. Thank you.